Okay, so this is the next video in relation to the annual accounts and the annual report, and especially the requirements that the Danish state and other states also have in terms of how do you make these reports and what needs to be in them and what size of the company are we talking about, what requirements in terms of what type of company we're dealing with. But the management review is a part of the annual report which has to be in there. The management review must include the description of the following: company's main activities, uncertainties or unusual conditions that may have affected the annual report, the expected future development. This is of course an estimate. It's not something that they necessarily will be able to be precise about. Special risks that the company may be affected by, significant events occurring after the end of the financial year, knowledge, resources, CSR activities, impact on the external environment, as well as research and development activities. The management review sets out the board of directors, the executive board explanation for the financial development in the financial year. Accounting policies. By recognition is meant the item must be included in the financial statement. By measurement it is meant that the values which the recognized items are entered. According to Danish Financial Statement Act, company must account for the recognition and measurement criteria applied to the items in the income statement, balance sheet, cash flow statement, notes, and management review. Example, FÅRUP, SOMMERLAND. Because it can be difficult to know, okay, what is it really in terms of measurement, etc. But, of course, the value of money is easy to, for example, the value of cash is easy to actually measure because it's universal in relation to currency level that we choose for example, the Danish krone, the US dollar, the euro, the Japanese yen. But an example, FÅRUP. The annual report is presented in accordance with the provision of the Danish Financial Statement Act for medium-sized company in reporting class D. The accounting policies are applied in consistency with the previous years. Recognition of measurement. Revenue is recognized in the income statement as earned, including value adjustment of financial assets and liabilities. All costs are also recognized in the income statement, including depreciation, which is the value that, for example, an asset loses each year that you can subtract in the income statement, profit and loss account. Amortization, the same, just for not fixed assets, and the impairment losses. Assets are recognized in the balance sheet when it is probably the future economic benefit will flow to the company, and the value of such assets can be measured reliably. Liabilities are recognized in the flow from the company, and the value of such liabilities can be measured reliably. On initial recognition, assets and liabilities are measured at cost. Subsequently, assets and liabilities are measured described below for each item. Depreciation and amortization. Depreciation and amortization of property, plant, equipment, and intangible assets aim to ensure that systematic depreciation and amortization of assets over their expected useful lives. The following useful lives are residual values have been applied by the company. It means that, for example, if you buy a roller coaster for SOMMERLAND, it's of course important that you expect to be able to use it for 10 years, and it has a depreciation each year of 5%, 10%. And that's a value that you can actually subtract in your income statement or profit and loss account, whether you choose to use one term or the other. In many cases, there will be no doubt as to recognition of measurement and individual assets and liability. Example, as I mentioned before, the recognition and measurement of cash. However, the situation is quite different with some of the large assets, such as machinery, vehicles, equipment, inventories, and trade receivables. In some cases, the measurement of liabilities may also rise to problems, for example, in the case of long-term loans in foreign currencies. Income statement. In the income statement, classified by type of expenditure, also known as the income cost method, the item of expenditure are categorized according to their type. This format is commonly used by trading and service companies. Here, for example, you have sale, then you have goods used, marketing cost, cost of the offices, for example, cars, other external costs. In the income statement classified by function, which is more, this format is typically used in manufacturing businesses. We have the income, revenue, product cost, and you have the gross profit here. Allocation of profit shows how the company intends to use the profit for the year or cover a loss. This is meant that, for example, this year's result is 8 million, almost 9 million. Here we want to transfer some of it to the next year. This can be paid as dividend to owners, to shareholders, etc. The balance sheet, statement of company's financial position on a certain date. As mentioned many times before, for example, it's typically done 31st of December 2000X. The balance sheet shows the company's assets, equity, and liability. Fixed assets intended for long-term ownership and used in the company. Fixed asset example, for example, truck, or train, computers, telephone, buildings, table. Current assets are assets which are doing the company's normal operation, changed over a relatively short period of time. Cash, receivables, inventory, investments. Equity in the financing made available to companies by its owners. This is, for example, if you start a company, you choose to want to invest in the company and place money into it. Provision and liability. Provisions are liability which are uncertain with regard to their size and the due date, and which pertain of the current financial year to previous financial years. Then the annual account also needs to include a cash flow statement. This cash flow statement shows flows for the financial divided into cash flow from operating, investment, and financing activities. This is a typical task, and it's a typical something that you need to look at. I have also made other videos in relation to cash flow. The most important thing that you need to know is the cash flow statement focuses on one thing. It focuses on all the money coming in this year and next year. So if you have made a sale in December, end of December 2016, and you receive the money in 2017, you will not include it in this year's cash flow. In Danish it's called pengestoppgørelse, and you see an example of it here. Operating profit, purchase of property, financial income, cash flow from operating, investment, financing activities, cash at the beginning of the year and cash at the end of the year. Consolidated financial statement. Consolidated financial statement and the financial affairs of the group companies are extremely complex, and the simplified description is therefore provided here. A group consists of a parent company and one or more subsidiaries. A parent company is a company that owns or is in possession of more than half of the voting rights in another company, the subsidiary. There may be several reasons for a company to establish one or more subsidiaries. It is a way of reducing risk, as the parent company potential loss is limited to the equity of the individual subsidiaries. Also, a company may, for tax reasons, decide to establish subsidiaries rather than divisions in other countries. In this example, Tom's is the example here. Tom's own a lot of companies. As you see here.